Hello and welcome to this session. This is Professor Farhad, in which we would look at a liquidation of a partnership. This topic is covered in financial accounting as well as in advanced accounting. Obviously, in advanced accounting, it's covered a little bit more in details. It's also covered on the CPA exam, the FAR section. As always, I would like to remind you to connect with me on LinkedIn. If you haven't done so, YouTube is where you would need to subscribe. I have 1,700 plus accounting, auditing, tax, finance lectures, as well as many CPA questions and Excel tutorials. If you like my lectures, please like them, share them, put them in playlist. If they benefit you, it means they might benefit other people. Subscribe to the channel, connect with me on Instagram. On my website, farhadlectures.com, you will find additional resources to supplement your CPA exam, as well as CMA, Enrolled Agent, and all of your accounting courses. If you are looking to improve your score 10 to 15 points on your professional examination, I strongly suggest you check out my website. So today we're going to be talking about liquidation of a partnership, and simply put, liquidation is something we're going out of business. I remember when Borders, maybe some of you remember this bookstore, maybe not, went out of business. I used to hang out in this place a lot when I was younger. Actually, I can't do that anymore. It's closed, but I can't do that anymore anyhow. So what do you do when you liquidate, when you go out of business? The first thing you do is you sell everything. Then you pay off your debt, you pay off your employee, you pay off your taxes, then whatever's left, anything left over, goes to the owners. That's the general idea. So this is the big idea that we're going to be working with when it comes to a partnership. So let's look at the specific detailed. So the partnership requires 3 steps following the sale of a non-cash asset. You sell everything that's non-cash. You cannot sell the cash. You can try to sell your cash. Somebody will give you exactly $20 for your cash. But if you have land, if you have inventory, like what Borders have, if you have stores, you're going to sell it and you're going to either record a gain or a loss on liquidation, on the sale. What does it mean? It means you sell something, you have a gain. It means you sold it more than its book value, or you have a loss, you sell it then less than your book value. So first you have the gain or the loss. And here's where students forget. Students skip over this first step. Once you have a gain or a loss, you cannot have both, you net them out, you either have a gain or a loss. That gain or a loss is allocated to the partner. So simply put, if you have a gain, the partner's account will go up. If you have a loss, the partner's account will go down using their income and loss ratio. So if, depending on what their income and loss ratio is, 50-50, 70-30, 60-40, whatever that loss ratio is, then your liabilities are settled, your liabilities are paid, you pay off your liabilities, and that's obviously logically how things happen. You sell everything, first you have to pay your obligation, and anything that's after your obligation goes to the partners, goes to the owner of the business. That's basically the logical step of closing the business. Now, the best way to illustrate those steps is to actually start to illustrate this in an example. The first thing we want to define before we illustrate anything is something called no capital deficiency. What does no capital deficiency mean? Let's assume I'm a partner in a partnership and I have a Farhad capital account. As long as I have a credit balance of $0 or $10, I don't have a capital deficiency. But if I have a balance of $2 debit, if I have a balance of a debit, it means I owe the partnership. Simply put, I took money out more than my capital balance. Okay, so the first thing we're going to assume is there's no capital deficiency. It means all partners, they either have a 0 balance. So 0 balance means no capital deficiency. It means your balance is 0, or you have a credit balance, which is good if you have a credit balance. That's basically what it means. So the first example, we're going to be making that assumption. So we have Z, P, and R, 3 partners agree to dissolve their partnership. The only outstanding liability is a debt of $20,000. Prior to the dissolution, they have the following balances. So here's where we stand now. They have cash of $178,000. They have a land on the books that's worth $40,000. They have an accounts payable of $20,000. Zane's capital is $70,000. Perez's capital is $66,000, and Rashid capital is $62,000. So the first thing they do, they're going to have to get rid of the land. They have to sell the land. So let's see how much they sold the land for. So they started the dissolution and they sold the land for $46,000. Well, let me ask you, do we have a gain or do we have a loss? Obviously, we have a gain on the land. How much is the gain? The gain is $6,000. We sold the land $6,000 more than the $40,000 book value. So we have a gain, and we're going to allocate the gain equally. That's how they distribute things among the partners. And after the sale, they're going to pay off their liability. So first, we get rid of the land, then we get rid of the 20,000. Let's take it step by step. So let's first compute, journalize the land. We debit cash 46,000, we get rid of the land, and we have a gain of 6,000. Now this gain here will have to be closed out to the various partnership, and it's easy. We said it's equally, therefore each one of them get 2,000. So we're going to increase Zain's account by 2,000, Peraz's capital account by 2,000, and Rashid's capital account by 2,000, and we get rid of this gain. So this gain is gone. Notice we debited the gain, so the gain is gone, and their capital, each one of their capital went up by 2K. Plus 2K plus 2K. Now the next thing we're going to do, the logical step, is to pay off the liability. Luckily, we only have one liability, which is accounts payable. So we're going to debit accounts payable, credit cash. Now what I want you to do, just basically, although I did not mention this, notice we had 178,000 in cash to start with. Then we sold the land for 46. So now we have more cash. Then we're going to pay off the liability of 20. So it's very important to keep track of your cash balance. So we're going to pay off the liability, which is 20,000. So this is, we paid off the liability. So after step 2, here's what our cash balance would look like. And our capital balances. Our capital balances for Zain is 72. It started with 70, then we added 2. The Perez, we started with 66, added 2. For Rashid, started with 62, added 2. The cash balance started with 178, added 46, subtracted 20, we have 204. Now we are ready to distribute the cash. Each one of them, notice, because we have no capital efficiency, gets exactly their account balances. Therefore, we credit cash. We debit the capital of Zain, 72, the H Perez, 68. So this is down to 0, down to 0, down to 0. So we debited all these accounts for the amount, and everything is down to 0. Now let's look at an example where we have a capital deficiency. And what does a capital deficiency means? It means in your capital account, you have a partner with a debit balance. Now why would a partner would have a debit balance? Well, the partner will have a debit balance for 2 reasons. Either they absorbed a lot of losses, because remember, net loss is close to capital, or they took out a lot of withdrawals. So they kept taking out withdrawals from the business. Therefore, their capital became like negative. We call it a capital deficiency or a debit balance. So either losses or withdrawals. Okay, this can arise from liquidation losses, excessive withdrawals before liquidation, or reoccurring losses. So it also could be when we liquidate, they had to absorb a large amount of a loss and they don't have enough capital. Okay, so a partner with a capital deficiency, usually, if possible, they should cover the deficiency. So if you owe the partnership $10,000, your capital, you have a debit balance, you should come up with $10,000 to kind of cover your capital deficiency. So simply put, if I have a capital deficiency of 10,000, I have to increase my capital by 10,000. So I would credit my capital balance and I will contribute cash of 10,000. So I contribute cash of 10,000, debit cash, credit capital. My capital is up to 0 and I'm good. Therefore, I satisfied my obligation. Sometimes I can do it, sometimes I don't. If I cannot cover my capital deficiency, who's going to cover my capital deficiency? Guess what? The other partner. So let's take a look at an example to look at how capital deficiency work. We have Zain, Perez, and Rashid. They agree to dissolve their partnership prior to the final distribution of cash to the partners. Zain has a capital balance of 19,000, which is positive, Perez of 8, and Rashid, notice here it's negative 3,000. So simply put, Rashid owes the partnership $3,000, and Rashid here is able to pay it. Well, if Rashid is able to pay it, simply put, here's what Rashid's account looked like before the dissolution. So they had a 3,000 debit balance. Now they credit the capital balance 3,000. They satisfied, they can move out. Okay. Now what's left? Now what's going to happen is what's left goes to the other partners. So simply put, we have $27,000 left. 19 goes to Perez, to Zain, 8 goes to Perez. So simply put, Rashid was able to cover his deficiency, which is really good news for the other 2 partners. Now let's take a look at when the partner cannot pay the deficiency. So let's assume you have a deficiency and sometimes you cannot pay the deficiency. Simply put, you don't have money to pay the deficiency. Let's assume the same information, except that Rashid don't have $3,000, and assume the profit and loss is shared equally. So remember, Rashid has a deficit of 3,000. Who's going to absorb the deficit? Well, guess what? the other partners. How are they going to absorb it? In their income, in their profit loss ratio, which is 50-50. Therefore, what's going to happen, Zain has a balance of 19, Perez of 8, and Rashid of -3. So what's going to happen, Rashid's balance will be added 3 to make it down to 0, and what's going to happen, the other partners, Zain and Perez, will basically absorb it. Notice Zain balance now is 17,500, Perez's balance is 6,500, and the entry will be to debit Zain, debit Perez, reduce their balances, increase Rashid's balance up to 0. Well, why? Because Rashid don't have cash to pay, therefore the other two partners will have to absorb the capital balance. And when we liquidate, we have 24,000 left. We credit cash and debit their capital remaining balances to close the business. Now the best way to illustrate this is to actually work another example a little bit more in details to kind of emphasize this. And by the way, if you want more about this topic, please go to my advanced accounting course where you have advanced partnership situation. This is basically for financial accounting. So we have three partners, D, G, and O. Begin by investing by the partnership as follow: D 190, G 340, and O 550. D, G, and K share of income 1 to 1 to 2. Simply put, 1 to 1 to 2 equal to 4. 1/4, 1/4, 2/4. So it's, let me go back down there. Let me go down to what I was. See all slides. Let me just, I went up by mistake. So what does that mean? It means they have the balance of 25%, 25%, and 50%. 1 to 1 to 2. You add them up, equal to 4, and you take 1 divided by 4, 1 divided by 4, and 2 divided by 4 to find the percentages. The operation did not go well. Surprise with the partnership, it didn't go well, and the partners eventually decided to liquidate the partnership. On July 31st, after all assets were converted to cash and all creditors were paid, only $80 remain in the partnership. So after everything said and done, here they're telling you, we liquidated, we sold everything, we paid off the creditors, and we have $80 left. Now compute the capital account balances of each partner after the liquidation of the asset and the payment of the creditors. Assume, and that's first scenario. Second scenario, assume that any partner with a deficit agrees to pay to the partnership to cover the deficit, prepare the journal entries, the cash receipts, and the final disbursement of cash. Assume that if there's any deficit, the person is not able to pay it, and record the entry, how the other partners will absorb it, So let's take a look at the first scenario. Before the liquidation, this is what we have. We have three balances, 190, 340, and 550. This is what we have. So total equity, $1,080. What we are told that after the liquidation, it means we have equity of that much. It means we have total asset of $1,080. But what we are told, after the liquidation, all the assets that's left is $80. It means we sold everything at a loss. So simply put, what happened is after the liquidation, we only have $80. After the liquidation, we only have cash of $80. What does that mean? It means we had a loss of 1,000. Although they're not telling you the loss exactly is 1,000, but they're giving you that information indirectly. So the loss is $1,000. What's going to happen? These partners will have to absorb the loss, 25%, 25%, and 50%. So what's going to happen is each partner will have to absorb 25%, 25%, and 50%. 250, 250, and 500. They're going to have to reduce their balances by that much. So now, Danica reduces their balance, Gaga reduces their balance, and Opera. Now, notice Danica has a capital deficiency of $60. Gaga still have $90, and Opera still have a credit balance of $50. Now let's look at the first thing we said. We're going to assume that they can pay it. Danica paid the deficiency. It means it's going to give the partnership $60 in cash, which is good, and that's going to reduce her balance down to 0. Increase her balance, not reduce it. Increase their balance down to 0. Therefore, basically, Danica is out because Danica paid her balance. Okay, and the other balance stays the same, but now we have $140 in cash. What we do next is we distribute the cash of the 140, 90, and 50 to the respective partners, and we debit their balances and we credit cash to close the partnership. So in this scenario, the person with the deficit was willing and able to pay it, which is good. In the third scenario, we're going to assume that the person cannot pay off. So simply put, this $60 will have to be absorbed by the other two partners. Now remember, it's 1 to 1 to 2. If we took 1 out, what we're left is 1 to 2. 1 plus 2 equal to 3. It means it's going to be distributed 1/3 and 2/3 to the other partners. So simply put, we're going to absorb it by 1/3. Once $60, it's absorbed 1/3 by Gaga and 2/3 by Opera, which is 20 and 40 respectively. And now Danika's out. Therefore, now Danika's balance, we reduce the balance down to 0. And we also had to reduce the other two partners because they had to absorb they have to absorb basically the loss that Danica did not cover. Now we still have $80. What we do is we distribute the $80 to the partners by debiting their account and crediting cash. And this is what we did here. Now, as always, I would like to remind you, if you want additional resources, if you want additional lectures, I strongly suggest you visit my website. Please like this recording, share it, put it in playlist. Remember, farhadlectures.com is there to help you pass your CPA exam, to help you improve your performance, to help you in your career. You invest for your certification once in your lifetime. You invest in your education once in your lifetime. It's going to pay dividend over time. Take it seriously, study hard, good luck, and stay safe, especially during those coronavirus days. Good luck.